Welcome to another edition of The Explainer. Today, we're tackling something that instantly spikes the blood pressure of pretty much any professional or business owner: tax mistakes. We are going to demystify exactly how the legal system handles human error, and we'll do it step by step. So what actually happens when you realize you've made a mistake on your tax return? You know that feeling, right? That sudden sinking pit in your stomach right after you hit submit? Or maybe it's months later, you're reviewing your books and it hits you. You missed a zero or completely forgot an invoice. Instantly, your brain goes to, am I going to get hit with a massive penalty? Is an audit right around the corner? Well, take a breath. By the end of this explainer, we're going to replace all that panic with a highly structured, predictable plan of action.
All right, here is our roadmap for today. We'll cover 1. The inevitable tax mistake. 2. Fixing omissions yourself. 3. Defective returns and processing. 4. Rectification of mistakes. And finally, 5. GST notices and disputes. Let's get right into it.
Section 1. The inevitable tax mistake. Grounding ourselves in compliance.
Before we get completely lost in the heavy legal mechanics, we need to get real for a second. With the sheer volume of specialized returns demanded by modern tax codes, occasional errors aren't just possible, they are statistically inevitable. I mean, think about it. Whether you're handling GSTR 6 for an input service distributor, GSTR 7 for TDS, or GSTR 8 for e-commerce, you are up against insanely rigid due dates. We're talking the 10th or 13th of the very next month. Unless your accounting department is entirely staffed by flawless AI, processing that many transactions with those kinds of turnarounds means omissions are going to happen. And honestly, the authorities know this. The law is actually built to handle it.
Section 2. Fixing omissions yourself. Proactive corrections before the notice arrives.
Okay, so here's the good news. This is all about the proactive remedies you have if you spot your own error before the assessing officer comes knocking. If you find an omission or a wrong statement in your original filing, you are not immediately locked into some terrible penalty phase. The tax code actively provides a built-in escape hatch. The law explicitly allows you to furnish a revised return. It's basically a legal redo, but, and this is a big but, you have to act within the statutory timeframes. And that brings us to timing, because timing is absolutely everything here. You need to memorize these countdowns. If the automated system flags a defect, you've got literally 15 days to rectify it. The clock is ticking fast. Need to file an appeal against an order? You generally have 30 days. Now, if you're proactively filing that revised return we just mentioned, you usually get a solid 9 to 12 months from the end of the relevant tax year. And for an assessing officer rectifying an order they've made, that limit is often capped at 1 year. Knowing exactly how much runway you have to legally act is pretty much half the battle.
Moving on to Section 3. Defective returns and processing. When the system catches your error first.
So what happens if you don't catch the mistake first? Modern returns go through automated, centralized processing. The computers are literally programmed to hunt for very specific red flags, what the law elegantly calls an incorrect claim apparent from any information. To translate that legalese into plain English, it means the computer cross-referenced your data and found a mismatch. Maybe you claimed a deduction but forgot to attach the mandatory substantiating info, or entry A completely contradicts entry B. The system sees that gap, flags it as a defect, and boom, an automatic adjustment is initiated. Once you're flagged, a very specific legal sequence kicks off. First, the assessing officer intimates, or notifies, you of the defect. Second, you are legally given an opportunity to rectify it. Third, you're handed that incredibly strict 15-day window we talked about to file your reply and fix the mess. And finally, pay attention because this is crucial. Failure to act within those 15 days means your return is legally treated as an invalid return. Let that sink in. It's as if you never even filed it in the first place. Ignoring a defect notice literally erases your filing.
Section 4. Rectification of mistakes. Formal amendments apparent from the record.
We're moving beyond simple return defects now. We're entering the territory where formal tax assessment orders have actually already been passed. The statutory trigger here is crystal clear. It says, with a view to rectifying any mistake apparent from the record, the assessing officer may amend any order passed by him. Basically, if there's a glaring, indisputable error right there on the face of the record, like a bad math calculation or they applied the wrong tax rate, the authorities can amend the assessment on their own. Or you as the taxpayer can formally point it out and request the rectification yourself.
Now you might be wondering, wait a minute, can an assessing officer just rectify my file and make me owe more money totally behind my back? Absolutely not. The law has a built-in safeguard for you. If a proposed rectification is going to increase your tax liability or shrink your refund, The authority absolutely must give you formal notice, and they have to give you a reasonable opportunity to be heard. They cannot just quietly inflate your tax bill while you aren't looking. Section 5. GST Notices and Disputes. Handling demands and show cause notices. This is exactly where we get into the heavy realities of a GST return error and omission and their notice reply.
Official GST dispute resolution guidelines are very strict. They map out the exact legal boundaries for how long the government actually has to issue a demand for unpaid or short-paid taxes. And they lay down exactly when they are required to serve you with a show cause notice, which, if you've never received one, is basically a formal document demanding you explain why they shouldn't take penal action against you.
Now, the law splits these disputes up based entirely on one thing: your intent. For what they call normal cases, meaning genuine, accidental slip-ups with zero malicious intent, there is a 3-year sunset clause to issue an adjudication order, and they have to give you that show cause notice at least 3 months before that. But if the authorities suspect fraud or willful suppression of facts, that window blows wide open. The sunset clause jumps to 5 years, and the notice has to be issued at least 6 months prior. The intent behind your omission completely changes the government's window to audit and penalize you.
Let's pull all of this together real quick. Here are your main takeaways. Number 1, mistakes happen, so be proactive and use that revised return mechanism. Number 2, respect the rigid statutory timelines. Do not sleep on that 15-day window for defect notices. Number 3, automated systems are always scanning for errors apparent from the record. Number 4, never forget you have a legal right to a hearing if a rectification increases your tax. And finally, keep those 3- and 5-year sunset clauses for GST audits top of mind.
Which leaves us with this final, critical question. If a tiny, subtle omission, like a misplaced decimal on a routine monthly filing, can trigger a defect notice in just 15 days or lurk in the background to trigger a GST audit literally 5 years from now, are your current internal compliance systems robust enough to catch that mistake before the government's computers do? It's something every single business operator and professional needs to seriously ask themselves. Thanks for joining me on this explainer. Until next time, stay sharp and keep those records accurate.